Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello, welcome to a new episode of Ilanomics. Banks have been in the news for a long time and not really for the right reasons. The talk has always been about the bad loans, the mounting NPAs, recapitalization of banks, and also the merger which the government has seen as some solution. But this is mostly, if not mostly, all about public sector banks. And public sector banks are not, are not supposed to be known for their efficiency, and the credibility and the government control of public sector banks has always been debated for some years now. But today we want to talk about private banks. And even private banks have been making headlines, not all of them, some of them, and not really for the right reasons. We've had banks like Yes Bank, Axis, IndusInd, ICICI, and just very recently Lakshmi Vilas Bank making news, not really for the reasons they would like to make news. The question that comes up now is there something for Indian depositors, Indian customers to worry about the safety of private banks? Because the government banks will be taken care of by the government. Your deposits are supposed to be safe. If something goes wrong, the regulator RBI and the government will put their heads together and probably merge them like they've done with some banks, 10 banks last month. But what about private banks? To discuss this issue, I have Professor Ila Patnaik with me from NIPFP. Ila, welcome. We don't want to alarm people. We don't want to, scare people that there is something wrong with private banks and they should be worried. But there are issues that are cropping up in the last few months where questions arise about the foundation, the safety of Indian depositors' money in private banks. What do you have to say about that? Is there reason to be worried?
You see, let me start with saying that the data that came out earlier this week from RBI is that there is an 88% decline in commercial credit. Okay. Now, what was happening was that it was really public sector banks that had got into trouble and that we were all thinking about and worrying about, and private sector banks, which had about 20 to 25% of the size of the total deposits in the country. Their credit growth was growing fast. So it was almost assumed that, okay, public sector deposit growth and credit growth is slow, but the private sector will be able to cater to the needs of the economy. I think even then it was a little worrying because it didn't look like private sector banks were all of them were very healthy. I think the root of the problem goes back to the fact that RBI has limited supervisory capacity. So one proposal that came up is that we should have another regulator, not a regulator, I'm sorry, a supervisor. And what is done in some other countries, for example, the US FDIC, when a bank starts getting into trouble, the FDIC steps in the US and starts looking at the books of the bank so that it is not allowed to become too weak and too unhealthy. And at the end of it, it shouldn't just be that the bank collapses and deposit insurance has to be given out. Now, we do have a deposit insurance corporation, and that deposit insurance is 1 lakh rupees. And I think a lot of people had not realized that is the cap. So when the proposal came up here that we will have a deposit insurance plus a resolution corporation, and the resolution corporation's job would be to step in and start looking at a bank when it becomes weak, and then to resolve it, which means to maybe merge it with another healthier bank, or at least offer it for sale, not a forced merger, but offer it for sale, or in the worst situation it could take it over, it could become a bridge bank, or the government could actually finally the resolution corporation would be given powers to take over the bank and resolve it. Now that proposal got bad political coverage, because people hadn't realized that actually there is this 1 lakh rupee deposit insurance, and they felt that that was new, and then there was a bail-in clause. Now what's happened after that is that while we today are back to the old Banking Regulation Act, where the only power that RBI has when a bank starts failing is to force merge it with a healthier bank. So we've had this earlier story of Global Trust Bank, Palai National Bank. Those banks would be force merged. The law was not changed. The bill was actually withdrawn. So what do you have today? You kind of then try to pretend, you means the supervisor, then tries to pretend that there isn't too much trouble. Banks are also trying to hide their trouble. There is today no mechanism through which there can be an orderly resolution of a private bank if it gets into trouble. Now, to go to your question of are banks in trouble? So, that given that background, apart from the news, one started looking at data and what we see in the data.
In fact, I was just wanting to, come to that point. You devised a new metric in the latest column you've written for the print, which was published today. Tell us about that metric.
So, normally what happens is that when banks or the supervisor is hiding bad news, then they don't tell you that this asset has gone bad. They try to hide that. Who is it that tries to find out if banks' assets have gone bad? It's usually a stock market stock speculator, a speculator in the stock market,
investor.
a trader who worries that, I bought these shares and the price is going to go down and then I'm going to lose out. So generally they would try to use every piece of information. So if a company has borrowed from a bank and the company is going bankrupt, then that information really feeds back into the share price of the bank. So the metric that one is looking at is that if one had the value of the deposits or assets, so assets and liabilities are pretty much match, but because they don't write down assets, we look at the value of deposits and divide that by the market cap. Then one gets a sense of what the market is thinking about that. Simply market cap wouldn't make sense because different banks have different sizes. So this is that what does the market think about the capability of the bank to repay depositors. And if you look at the number so we've got June data for deposits and we've got June data for market cap, and then later we also look at September data for market cap because till now the June data is the latest for deposits. We haven't got the September for deposits. When you look at that, you find that there's a bunch of healthy banks, Axis, ICICI, HDFC. And then there are a bunch of very
unhealthy
weak banks. And
7 to be exact.
7 to be exact, 7 in June, and then another gets added, an 8th gets added in September. Yes, banks' stock prices crash. So whenever the stock price of a bank crashes, that means that its assets, according to the people in the stock market, have a problem. Somebody is not going to. So if the assets are loans, and if the loan is not going to be repaid, then that is a problem. Now Lakshmi Vilas was one of them, and that has already been put into some sort of a PCA by the RBI. So these are the banks that are in trouble. The question I think before the regulator today is that it's not easy to put taxpayer money into private banks anywhere in the world. It is not easy to shut down banks. You can't just give out the deposit insurance of 1 lakh rupees and expect people to go home happily, because I think that cap is very outdated. It's been there for many years. By now it should have perhaps been raised to about 5 lakhs, which would have covered about 99.5% of depositors. But that cap is very low.
So, sorry to interrupt you, Ila. Why has that cap not been increased? I mean, it's a question that keeps coming back frequently. When the FRDI bill was talked about, and there was a lot of opposition to the FRDI bill. Why has this cap remained at 1 lakh? Why has nobody thought of increasing it?
I think part of the reason for that, as well as the whole lack of supervisory capacity and us not really pushing for a resolution framework, reason for that is that the banking system is dominated by public sector banks. Public sector banks, you don't allow them to fail. If you're not going to allow them to fail, why worry about
Insurance?
Why worry about whether the bank will fail and therefore we will need a resolution corporation? Why even put resource into adequate supervisory capability?
So
Today the question is, today your question should be, so Ila, why is RBI's supervisory capability so weak? I mean, we saw Punjab National Bank, we saw the Nirav Modi case. They said the SWIFT was not talking to the core banking system.
And we saw something like the PMC just recently.
So the question to ask is there a moral hazard here? Is the regulator thinking, okay, for 75% of banks, and that's the culture that has developed, the government is going to bail out. Punjab National Bank, despite 11,000 crores being lost, is got money, is surviving. So the regulator has not developed that capability. Our legal system has not created a resolution corporation. About 30 countries, right after the 2008 crisis, went ahead and created resolution corporations. We brought in the FRDI bill, there was opposition, we withdrew it. We did not think, what are we going to do if private sector banks fail? Are we going to keep, at the end of it today, SBI is perhaps one of the only really healthy public sector banks. Will we get SBI to buy up, my list of 7 weak banks? That will be really bad.
It's not good for SBI. But
even the deposit insurance, it's the same thing. That because of this moral hazard issue, it's not really been taken care of.
But by implication, Ila, does that mean you need to have a separate set of rules and laws and regulations for private sector banks?
Not really. A regulation should be ownership neutral. If a public sector bank is failing, after all, why should the taxpayer have to pay? Yes, you should be able to resolve it. I would say that in today's politics, if the government feels that they can't do it, because there are poor people who don't understand, they cannot do the calculation I tried to do and see what is the health of a bank. There are people who are unsophisticated consumers. Perhaps there is a need today where you allow public sector banks, you don't let them fail. You start this process for private sector banks, and then over time, as the banking sector health improves, as supervisory capacity improves, you can then move on to include public banks as well. Or practically, you have ownership neutrality. Everybody should be in that cover. If you can, you've got majority in Lok Sabha, and they can get bills passed in Rajya Sabha. So, and effectively, maybe, make that political judgment. This is politics. Putting taxpayer money in anywhere is politics. So that judgment can be made.
So, Ila, we know what the governments need to do, policymakers probably know what they need to do to address the situation. But what would be your advice to depositors who obviously don't know as much as you do, or the governments and policymakers do?
See, at the moment, there are some healthy private sector banks because they offer better services, so people go there. You and I both go to private sector banks because they give us better services. Among public sector banks, I think SBI is still standing healthy. The others will also be looked after. Okay. But beyond that, it's with rate cuts, and if they get transmitted, there's a transmission to interest rates. then that's not going to be the place to get the best returns. So at the moment, it's difficult. The banking sector is in trouble. The government will keep bailing out, but it's not going to be a healthy banking sector immediately. Because even if you pass the FIDI bill tomorrow, creating an institution takes time. So when the IBC was passed, after that the IBBI was set up. It had to function immediately, and we see the problems that have been created. So any institution, to make its rules, its IT systems, to have its bylaws, it all takes time. So you'll still need a couple of years to have a well-functioning resolution corporation. So you just... At least one advice would be, at least don't go after high returns. If a bank is promising you 6% return on their savings deposit when everybody else is giving you less, don't be greedy.
Don't be greedy. The banking sector is in trouble, but don't be greedy. Conservative returns are probably better in these times. That's the word of caution and advice from Professor Ila Patnaik. Thanks for watching this episode of Ilanomics. Do subscribe to ThePrint's YouTube channel. There are many more videos out there. We'll come back to you next week with another episode of Ilanomics. Thank you.